Good morning, everyone. Another video today on Grab Holdings, improving fundamentals for the past 2 to 3 years, but the stock has stayed flat, still selling at $5, market cap of 20 billion, only up 6% year to date. And if you take a look at the long-term trend, looks like it hit a low of about $2.50, $2.30. It's only been hovering around $3 to $5, while the fundamentals of this company have done nothing but improve. So let's go ahead and take a look at that today. But in my opinion, this company has stayed undervalued. It has not moved. In the long run, if you want to diversify outside of the States, this is a good company to look at. So PE ratio, it's saying it's at 189. I don't really look at the PE ratio. I try to look at growth trends. I'm not too worried about all these specific details on the PE ratios. There's a lot more things to look at when you're researching a company. There's other important KPIs that you need to be tracking. And just because a company is selling for a PE ratio of 189 and people label it expensive, that's just not the right way to look at a company. I think especially in this day and age, you miss out on a lot of the growth companies. This is one of the most popular valuation metrics that people like to look at, and they sort of get turned away when they see it at a high point already. Like for Grab, it's already selling at 189 PE ratio. Traditional finance would say it's too overvalued already, but this valuation metric is not too useful when you're researching companies that are unprofitable in the first couple years or high growth companies. These high growth companies often reinvest heavily, depressing their earnings, but the real value of these types of companies lies in the future cash flow that they could produce later on. And don't worry too much about today's income. If they're posting negative profits, there's a lot of accounting that goes on behind the scenes, especially for these tech companies and how you value tech companies. If you rely strictly on the PE ratio, you miss the story of the company and you overlook the financial health of the company, growth prospects, and the risks that could be involved. So let's go ahead and take a look at the latest data for Grab Holdings. I already have it up right here. We'll pull it up. So total revenue, earnings per share, we have profit margins, free cash flow per share, cash flow from operations, and also the bottom line net income, which they are positive, by the way. But we'll go ahead and start with total revenue up top. Latest quarter, they posted 819. That is up 23% year over year. They posted 664 second quarter of 2024. Now sitting on 9 consecutive quarters of total top line revenue growth. This is actually, the latest quarter is actually one of the biggest quarters they posted. Fourth quarter of 2023, they posted 30% year over year growth. We want to be looking for companies that are growing their total revenue top line 25 to 50% year over year. If they're growing 100% year over year, that is a huge growth company. Earnings per share, they posted 0.01, up 200% year over year. For the past year for Grab Holdings, they have posted positive earnings per share. Looking good. We have profit margins next. Go down to profit margins right here. 43% profit margins. This is the highest that they have ever posted. 43% in profit margins. So go down to cash flow from operations and free cash flow per share. Grab did post negative cash flow from operations and negative free cash flow per share year over year. And the main reason why it is down is because they are focusing on GrabFin. So besides just being a ride-hailing service, they are trying to become the everything app. And one of the categories that they're getting into is their financial services and loan department. So you have ride hailing, you have financial services, they're an insurance company. They're pretty much a firm, buy now, pay later, already built in the app. They have a wallet in the app, travel insurance, ride insurance. They have Grab Pay, Grab Finance. These are all the partner banks that they work with. This company is huge. Go back to this real quick. Negative free cash flow per share and negative free cash flow from operations. Why? Well, because according to the transcript, they had higher cash outflows from the lending activities that they are pushing, and all this is suppressing operating cash flow. Basically, it's due to less cash coming in from their bank deposits and more cash going out to fund their lending growth. On a full year trailing basis, the company is still posting strong free positive cash flows. So go down to net income. 35 million in net income versus negative 53 million. That is up 166% year over year. We have 2 consecutive quarters of net income growth in the triple digits, and now 8 consecutive quarters, 2 years of consecutive year over year net income growth. Looking good for Grab Holdings. So here, let's pull up the financial services section. Again, this is the part they are pushing, which caused the cash flow to be negative. So loan portfolio. They are aiming for this thing to be $1 billion by the end of 2025. From quarter 2 of 2023, they had about 200 million in their loan portfolio. Now they're about to hit 1 billion. From last year alone, it is up 78% year over year, attributed to ecosystem lending and higher lending volumes. Loan disbursals grew 44% year over year to reach 2.9 billion annualized in quarter 2 2025. I mean, just look at this growth. This as one of the main KPIs when you're researching this company. You want to see loan portfolio grow, more interest income for them later on, and keeps people stuck on the app. It's one of the competitive advantages that Grab has, causes stickiness to their consumers by pulling out loans and having to pay Grab back. So go down to financial services, quarter two of 2025. Revenue from their financial services has jumped up to 84 million. That is up 41% year over year from 60 million quarter two 2024. Revenue has gone up for financial services. Their loan portfolio is up 78% year over year. So their financial services business is growing like crazy and sitting at $5 at a $20 billion market cap. It just seems like a steal to me. It's a screaming buy, not financial advice, but it's a screaming buy. One of the companies that I've been following that have done nothing but improve their financials in the past 2 to 3 years while their stock sits flat. And so keep an eye on this company, guys. This is one that's super undervalued in my opinion, but they just posted great quarter two. And yeah, let me know what you guys think. Just keeping this one short, just a quick little update of quarter two. Great numbers. Don't forget to like, subscribe. Thanks for watching this video, and we'll see you in the next one.
Here we go.